All right. Good afternoon, everybody. It's 3 o'clock, Tuesday, December 3rd, 2024. I'd like to call to order the Other Post-Employment Benefits, or Opeb, Trust Committee. Pursuant to Governor Healy's March 29, 2023 order extending the temporary provisions pertaining to the open meeting law until March 31st, 2025, the meeting of the Opeb Trust is in hybrid format and is being recorded. All meeting recordings will be made available after proceedings on the town's website and YouTube channel. Meeting, YouTube, and Zoom links can be found at www.suttonma.org/cable/department. Since this is a hybrid meeting, we need to take a roll call vote, not a roll call vote, but attendance to tell everybody whether you're here in person or by Zoom. So we'll start with Lisa.
Okay. Lisa Lynch in person.
Harrison McKinley in person.
Tim Harrison in person.
David Hall in person.
Chris Woodruff by Zoom.
And then any votes that come up will have to be a roll call vote also. So first item on the agenda is the approval of the minutes from January 30th, 2024. I have a motion.
Second.
No.
Motion
somebody needs
to
make a
approve.
motion.
I,
You want to make the motion?
I move to approve the minutes as presented.
Second.
All right, any discussion? All right, I'll take a roll call vote.
Lisa Lynch, aye.
Harrison McKinley, aye.
Tim Harrison, aye.
David Hall, aye.
Chris Woodruff, aye.
All right. Next item on the agenda. So I had a couple handouts for the committee. Not really going to spend much time on them, but just sort of hand out every time. One is the history of the Opeb contributions from when we started in fiscal 2012 through current. Shows that we have contributed $4,583,994 into the trust. It is through October 31st. We have accumulated earnings of $1,516,038 for a trust fund balance October 31st, 2024 of $6,100,032. And then the second information is just, handout is just for, again, just for your information. It just shows the history from 2016 through 2024 of the retiree health insurance premiums paid by the town, and it's broken out between town and school. And in each case, it also lists the number of retirees that we're paying premiums for. Any questions on those handouts? Anyone in the audience, you're welcome to grab a handout. There's some extra copies over there. So next item on the agenda will be a presentation by our actuary, Parker Elmore, from Odyssey Investors, or Advisors, sorry.
Thank you.
Well, thank you for having me out. I'll go through this and try and be respectful of your time, but if you have questions,
Can
ask.
you, for the audience in the record, can you just introduce yourself
Sure,
and your
Sure.
company?
Parker Elmore, Odyssey Advisors. I'm the actuary who works on your Opeb plan. And we have a team of people, it's not just me, I promise. But anyway, so again, I'll try and be respectful of your time. If you have questions, ask away. Don't feel like you have to wait to the end. So I'll give you a quick 30-second overview about our firm. We've been around since '98. I've been doing this stuff since the late '80s, so a lot longer than that. We've got about a little more than 500 municipal clients for whom we do this type of work. Around the U.S., we're in 37 states, so we're in all over the place, although we have a very large presence in Massachusetts. And we have clients in South America, Australia, so I spend a lot of time on planes. With that all said, so the next page is really, why do we do an Opeb valuation in the first place? Everything was fine, everything was cruising along, we're doing pay-as-you-go, life was great. Why did Gatsby come along and come up with all this stuff? The basic gist of it is, it's hard to, as a financial investor, look at your financial statement and go, what have they promised? What's the value of these promises? So it was a way to standardize the accounting. So the town of Sutton, town of Walpole, city of Boston, Los Angeles, we're all using the same set of rules to value our liabilities. And the idea here is to value them in a consistent manner using consistent assumptions, and that's really what this is all about. So it's not a matter of we're not just doing pay-as-you-go, and we go, hey, look at this town, they've got 100 actives and no retirees. Look at them, they have no liability. No, they have a liability, they just haven't started paying it yet. Whereas there's another town that might have 100 actives and 500 retirees, you go, oh my God, they've got a ton of liability. It's all being paid off. So you have to look at where people are in that, the pig and the python story, where are you in your liability journey? And that's really what OPEB accounting is really, and the GASB accounting is really to help you get there. You know, one of the things I would mention as part of this, and the reason why you and a lot of other people have started funding, is because these liabilities are large, getting larger. And, you know, in the state of Massachusetts, to be clear, not a lawyer, don't want to be a lawyer, can't give legal advice. With that said, under Mass General Law, once you adopt OPEB, you have adopted OPEB. It's not like there's an exit ramp and go, I don't want to do this anymore. There's no way to get out. You know, once you're in, you're in. You can change your contribution percentage to charge retirees up to 50%. That's as far as you can go under Mass General Law. So once you've adopted OPEB, you have OPEB until, so long as the town exists. So I suppose you could unincorporate the town. I suppose that's one option. I don't think anyone really wants to go down that path. So my point is, once you have it, you have it. So therefore, the responsible thing to do is fund it, which is what you guys are doing. So we'll talk a little bit about kind of where you are, what happened over the year. Now, this is the roll forward year. So we do a full valuation every other year. In the interim year, we basically, for lack of a better, we true everything up. We change the interest rate to reflect whatever the market is currently saying assets will earn. We look at what your experience was for the year. And that's largely what happens during the year. So in your case, the liability went from 24.9 million down to 24.1 million. That's all because of discount rate, the interest rate we use to value all future payments back to today. That went from 6% to 6.76%. Now, the reason why that happens is we use survey data. And basically what happens is the investment community, 35 or so financial advisors around the US, they looked at things and said, we think in the coming X number of years, 10, 20, 30 years, we expect assets returns by asset class to be higher than we thought the prior year. So each year we reevaluate whatever the marketplace tells us. And at this point in time, they were more optimistic about future returns than they had been the prior year. So that increased your discount rate, lowers your liability. So in your case, your assets went from 4.34 million to 5.4 million. A great year. Good for you. And makes the presentation for the folks behind me and from Bartholomew a much easier presentation when you have great asset returns. So your net OPEB liability, what most people call unfunded liability, went from 20.5 million down to 18.7 million. So I know it doesn't seem like much when you look at it and go, oh, we're 22.3% funded. You know, but on the other hand, I would tell you guys, you're in the top 20% across the state. So only in the world of OPEB can you be 22% funded and go, we're a star. We're in the top 20% of all of our peers. So you guys have done very, very well. Doesn't mean there's not a long way to go. And the thing I would tell you on this is I just posted a thing the other day. Massachusetts is third in the U.S. on net taxpayer-supported debt per capita. In other words, the state of Massachusetts per capita has about $7,000 of debt per person. And then when you look at it and go, Massachusetts over the next 25 to 30 years, you expect to have a stable to declining population. You do the math and go, there's never going to be an easier time to fund than there is today. It's only going to get harder. So I would encourage you guys, to stay on. I know it's going to be hard. I know there's going to be people who go, well, we can do this, we can do that. Kicking the can down the road does not solve the problem. The can only gets bigger. In terms of the income statement part of the financials, if you will, the important part I would tell you here is about the service cost, about $616,000. That's about $2,000 a person. And the reason I bring that up is if you think about it, if Johnny or Mary works for you and they're making $50,000, let's say, they're really getting a $2,200 or thereabouts deferred benefit payable in retirement in the form of medical benefits. So that's really just when you thought your total cost of employment, what does a person cost you? Their salary plus their benefits, this is really part of that fringe rate.
And that big reduction in that cost year over year is a result of
What it always does is it uses the prior year interest rate. So if I go back 2 years, you guys are about a 4% interest rate, which means therefore last year, the service cost was based on a 4% rate. This year's service cost is based on last year's 6% rate. So as the interest rate goes up, liability goes down and vice versa.
So we'll see that continue next year.
Assuming, yeah, next year I would expect a slightly lower service cost again next year because we're using 6.76% for next year's service cost. Assuming demographics, nothing weird happens with demographics. Again, being the interim year, there's not a heck of a lot that happened because it's the same census as the prior year. The big one is the interest rates went up, therefore the liabilities go down. So that change in interest rate from 6 to 6.76 cuts $2.1 million off your liabilities. Now, the thing I tell everybody is there's what I would call real reductions and phantom reductions. Assumption changes are just that, they're assumption changes. The benefits payable under the plan didn't change by a penny. So yeah, we take $2 million off your liabilities, but here's the thing, if next year the investment community goes, hey, we think now earnings are only gonna be 6%, well, guess what? That $2 million gonna come right back. So that's not really it's not a permanent reduction. It's while the investment community thinks we're gonna earn 6.76, it goes away until they change their mind. So again, benefit plans, that's really where the real money is, premium reductions, things like that. That's the real money. The rest of these are, I can assume everybody's going to die at 55 and your liabilities go to zero. But that doesn't mean they're going to. It just means I made an assumption. So we want to make sure that, again, we differentiate between, I guess, what I would call real things and assumed things. So what are all these magical assumptions I talk about? Well, one, the discount rate we spoke about, that's the interest rate we use to bring all the future payments back to today. But then the probability of termination. What's the probability that somebody retired today at 25 is still here at 26, 27, 28? Okay, they make it all the way to retirement age. What's the probability they retire at 55, 56, 57? Okay, they decide to retire. What's the probability they elect to take coverage? What's the probability they like to cover a spouse? And then the all-important, what are healthcare costs going to be in the year 2050, 2070, 2090? So we have a complicated formula based on GDP and resistance points and overall it's CPI and various things. It's a complicated model. The short answer is if you said about 4.4% a year, you'd end up at pretty much the same number. Ours has all kinds of bends and curves, but it ends up about the same number as a flat 4.4.
Parker, one quick
Yeah,
question.
yeah.
So on your healthcare cost inflation,
Yep.
you're using 9%. Is that statewide, national? Because our own experience last year was 10%, this year maybe 12%. So,
Retirees is probably going, I don't know where.
so we're doing,
That's going up 18% this year.
yeah, so our actual experience is a lot more than 9%.
Yeah, well, two things on that. One is you have to differentiate between your Medicare costs, your Medicare supplement premiums, and your active premiums. Your active premiums, while they hurt in a lot of ways, are honestly not terribly important for OPEB. So the active plans are maybe 25% of your OPEB costs. Your Medicare supplement premiums are 75% of the cost. So that's really the number we tend to focus on. With that said, the reason why we bumped up our claim expectations a couple years ago was because post-COVID, everyone during COVID got very flat to low renewals. Well, doctors, hospitals, and nurses still want to get paid. So all their contracts, they're on 2, 3, 4-year managed care contracts, those ran out. Then come renewal time, they want to get paid. So we started to see a spike about 2 years ago of healthcare costs. And now we expect that to come back down over time. But you're right, we are seeing a lot of 10, 12% renewals right now, and you're not alone in that. But again, this is really meant to be a long-term forecast over the next 60, 70 years. So yeah, we'll certainly expect to see a spike here in the next year or two for a lot of folks. But again, the Medicare supplement's really the main thing to focus on. Those have been more moderated for now.
Thank you.
Yep. In terms of the benefits offered, it's comprehensive medical, dental, and then $5,000 of life insurance. Your average active plan is $763, is a little on the light side, I would say. We see people more like around $850. So you guys have despite our most recent comment, you guys have done a pretty good job of managing the cost on that. So you've done a pretty good job there. And your Medicare supplement plan of $382, that's right about what we see, in your part of the state. Generally between $375 and $400, so you're pretty much right on the number. So I don't really foresee any issues there. the always important, where do I stack up? So here's some percentile rankings about where everybody is. And again, you guys are 22%. The 80th percentile, or better than 80% of the people among towns, is 21.34. So you guys, I said, you guys are in the top 20% across the state, as sad as that is to say. And again, you'll see utilities do a lot better. Simple reason, they can build it into their rates. If you're a water district, you say, I'm going to add an extra penny to my water rate, I have money now, I can fund OPEB. For you guys to say, I want to add an extra penny to my taxes to fund OPEB, not quite as easy. So that's really why you'll see your gas companies, your electric companies, your water companies have much better funded. As far as comparison to peers, I mean, listen, everyone compares themselves to somebody else. We tried to find towns of similar size, geography, things like that. I mean, the reality is you guys, across the state, your guys' discount rate is higher than the average. Your service cost, therefore, is lower than the average. Your funded ratio is doing very well compared to everybody else. And your per covered retiree cost of $4,800, again, you're much better than the statewide average. So again, I think, you guys under any metric compared to your peers are doing very well. Again, you can always find somebody go, well, why aren't we doing better than them? There's always somebody, but I mean, again, if I were to look at it, you guys done a very nice job of managing your plans, getting your funding going, keeping your costs under control on the benefit side. So again, you guys, I'm not here day to day, but from what I can see from the outsider, it seems like you guys have everything pretty well under control in that regard. The service cost per employee, as I talked about, the $2,200 per employee. I mean, it varies by group. Some of these groups are so small as to be, saying for transfer station, when you got one person, it just tells me how old or young they are is really all it tells me. The reason why we mainly do it is for public safety, because public safety, you'll see, is generally higher than everybody else. It's a really simple math. Public safety employees tend to retire earlier, which therefore means you have to accrue the benefit over a shorter period of time. It also means you get the benefit for a longer period of time. So therefore, they have a higher liability amortized over a shorter period, ends up with a higher service cost. So it's pretty basic math in that regard. And then the all-important, to play Nostradamus, what does the future look like? Based on your current funding methodology, you guys are expected to reach full funding around 2045 or so. Now, and that's in column, you'll see it in column 3 there, the net OPEB liability. And at that point, then you start withdrawing money from the trust rather than contributing money to the trust. What I would encourage you to look at really, the liability numbers get scary when you go from 24 million to 90 million, and then it becomes an excuse not to do anything. So I always encourage people to look on the right-hand side where you look in present value in today's dollars, what do things cost? And your liability come 24 million to 27 million over the next, 40 years. And the pay-as-you-go cost goes from, 500,000 and change, but it's going to go to like 1.3, 1.4 million dollars over that period of time. So that again is why pre-funding is so important, because retiree healthcare costs are going to eat up an ever larger portion of your budget down the line. And so pre-funding gives you the ability to have a stabilizer, if you will, in your budget. Otherwise, the people in 2043 are going to go, why didn't these guys do anything when they had a chance? So that's really what you guys are doing now, is to provide stability in the budget rather than, kick the can down the road and go, well, people in 2043, you're on your own, not my problem. You guys are, being more responsible about it. And I'm not going to say that, everyone is. I mean, listen, a lot of people have started to fund, but as the folks at Bartholomew can tell you, a lot of people are not funding a lot. A lot of people have been late to the game. And there's a million excuses. All of them make sense individually. I need to buy a fire truck. I need to put a new boiler in a school. They all make sense. So I always tell folks we want OPEB to get a seat at the table when you're making capital decisions. It doesn't have to be the only thing, but it should be considered, because this is a long-term liability. And if you don't address it now, it only gets harder. And I know there's a lot of stuff there, so roaming around with lots of numbers, but questions, comments, concerns?
Yep, go ahead. Anybody?
Go ahead, Dave, if you. My only question, well, not my only question, but one question I had is, there was an effort statewide to mandate OPEB contributions to Volpac, to try to introduce a bill that, there was all sorts of issues, and eventually it didn't go anywhere. Went to a couple of hearings back in 2010.
Yep.
So, what is the state doing? And I haven't heard them talk about OPEB much at all. And to me, 14 years ago, they were talking about it, and now all of a sudden, it's not an issue. I think it's still an issue, but I wonder why the silence from the State House, because it's it's a federal issue.
Yeah, well, I mean, the reason is that if you look at Deval Patrick and his deal, they had a committee, they came with, a platform or a proposal. I believe it was 13-1 out of committee, and then promptly died in the legislature. Because there's no, in order to find where the money is, you have to actually talk about people currently receiving benefits.
Right.
So the deal they did in 2012 was to say, people hired after April 2nd of 2012, you guys will be affected this way. I mean, it has some impact, but very little impact. And so that's the thing. The problem is, I mean, I know political people everywhere, so I have to be careful what I say, but voters don't want honesty. If you tell people, hey, guess what, guys, we're going to have to do this, and we're going to have to actually cut benefits for existing populations. Everyone says they believe in that right until they go into the voting booth, and they tell you something different. Or we can raise all your taxes. Oh, no, we should definitely be this, and then they vote against it. So that's the problem, is the politicians look at it and go, the voters are telling us, they talk a good game, but when push comes to shove time, the voters aren't going to vote for it. And so that's why the politicians, I think, are just following with what the voters are telling them. I mean, at some point in time, there's going to be the crisis like we had in Detroit, or we had in Jefferson County, Alabama, or we had in Orange County, California, Stockton, California. When you have the crisis, something will happen. Unfortunately, that's the only thing that seems to move people. I mean, I wish people would think ahead, but that's just, there's no votes in thinking ahead.
Thanks.
Yep.
No, I just got geeky questions about a few assumptions, but it's pretty deep in the weeds, so I think I'll leave it alone.
Okay, I mean, I'm happy to answer, or you can do them offline, whatever you want to do.
Anybody else have any questions for Parker?
Chris?
Chris?
No questions for me, thanks.
Okay,
All right, thank you very much. That was a
Thank you.
great presentation, appreciate it.
thank you. Now coming to start.
And next on the agenda would be a presentation by Bartholomew and Company.
Your challenge is to be more exciting.
Good afternoon. How is
Actuaries.
everybody? Good to see you. You look great. Hope you had a good Thanksgiving. Thank you for inviting us to this annual meeting.
Don't encourage him. Yeah.
Really? I mean, as if he needs any encouragement.
You gave me the intro. Thank you.
One's enough for me, that's good. Yeah, you can just put them on the corner thing, that'd be great.
Please introduce yourselves to the
Excellent.
audience.
Will do. Thank you, Chairman. Brian Jemros from Bartholomew and Company, and I have along with me Kathleen Glowacki from Bartholomew and Company as well. Kathleen recently had she was on our internal investment management team for the last 9.5 years. As of February of this past year, she is now one of our client-facing investment advisors on the road full-time. So no interruption to your service here, just an add-on to our team. So just want to welcome her on that new role. So thank you.
Congratulations.
Thank you.
It's been about a year since we've seen you, almost. We've been working with the town almost 13 years this February, and we're going to get right into the review. But for those that don't know, and anybody new, this wasn't always in a 70-30 portfolio with full allocation to private markets being private equity, private real estate, and also the new add-on with private credits, but we'll talk about that later. So when you're looking at some of the performance data and the benchmarks, please keep in mind that this was not always in a 70-30 portfolio with full private markets. So we'll give you those dates as well. Actually, just for the record, Yeah, we'll get into that in a minute. I'll get that for you by the end. We'll get through it. I'm going to pass you over to Kathleen. She's going to go through the market review. Good news to report. We don't get paid by Parker, I promise. Just full disclosure. So thank you for the kind remarks. Go ahead, Kathleen.
Great, thanks. Yeah, so, and same as Parker, if you have questions along the way, just interrupt. But here we have all of the information we put in front of you, and I'll try to talk through some of it so everyone can understand what's going on. Everything we have is as of 11/30, 2024, so we try to keep these up to date. So as of the end of last month, the portfolio is just over 6.28 million at this point. If you flip to page 2, this is really a visual, so I won't belabor it too much, but to Brian's point, you can visually see, you know, in 2012, being early adopters to Opeb, which is great as well, this portfolio started a little more conservative, and that was pretty typical for OPEBs at that time. And then over time, you've, you know, added equity exposure, really because you should. You're in, you know, as Parker said, you're about 20-ish% funded. You need it to grow. It needs time, and you need it to go through those market cycles. So kind of visually, you can see it there, but we'll dig into some of the actual data. So on page 3, on the left-hand side, I'll start with that. I think that this is probably the most important information. So when you think about everything that's happened, we think about OPEB for long term. And so if you go back to February of 2012, contributions since February of 2012 up until the end of last month have been about just under 4.6 million. Call it. You've had no withdrawals, of course, because you're in accumulation phase. And then you have realized gains of about 112,000, unrealized gains of about 755,000, dividends and capital gains of about 916,000, management fees to our firm over that whole time frame of about 84,000. So that ending balance of that 6.28 million, so a total gain since 2012 of $1.7 million, which equates to a total return, so annualized year-over-year return of 6.04%, and that's net of our fees as well. So that's truly, you know, your performance return. And so again, even with the portfolio being a little more conservative in the beginning, that's still, all that considered, 6% is still quite good, relatively speaking, for a lot of the portfolios we see. So that's excellent. Right-hand side is the fiscal year so far. So just from July 1st of this year up until the end of last month, you've contributed 505,000 into the portfolio. You have some of that same information there, some realized gains, some unrealized gains, dividends, management fees there as well. So just since July, a total gain of 372,000, which is an annualized return of 6.6%. And not, I shouldn't say that's annual. It's not an annualized return, excuse me. It's just the return over that few months that we've had. So it's been quite strong, which we can talk about some of the latest stuff going on there. And then at the bottom, visually, you can see what you've put into the account on the flow line or that gold line, and your market value has, you know, of course, grown over that line over time, which is exactly what we want to see there.
That 505,000 contribution, that's the 100,000 that we budget annually, plus 10% of free cash, plus 5,000 from the sewer department.
Correct.
That's essentially the board's policy that gave us the 505.
Correct.
All right.
Do you have timing, a plan for timing on when you make those contributions, or you just do it as soon as you have the number for the year?
Yeah, I've been told we're not supposed to try and time the market, so.
It's time in the
So-
market, no hers.
In this case,
Some-
probably worked out well, so.
Right, so it's basically sometime after votes are taken.
Yep.
Budgets are approved.
You just get it out.
Yep.
Thank you.
On page 4, we have, so we tell you all of our performance, of course, but then we like to compare you to some benchmarks, just to kind of give an idea of how this has performed versus kind of the broader market. And so what I'll say is a reminder of how we view this portfolio. We want to perform in line with our benchmarks with hopefully less volatility. Because at the end of the day, these are town funds. We don't, when the market's down a lot, your OPEB will be down. You have 70% exposure to equities, but we want to try, it's more important to us to protect in a difficult year than kind of gain a ton in the really, really strong years. So that's still our philosophy, and that's always been the philosophy. So you can see this portfolio is that top line there. So we're comparing you to 3 benchmarks. The most applicable one I'll touch on is the third one down that says 55, 25, 20, equity, bonds, and liquid alternatives. And so again, this is our 70-30 benchmark. So if you look at the since inception performance, your portfolio has been up just about 6%, and that benchmark has been up about 6.5%. Shade of gray, really, for how much more aggressive this is at this point. So it's still, again, the town's portfolio has done great. But that can give you some idea of what a 70-30 kind of going forward we expect. Maybe that's 6 to 7% annualized return. And I'll mention too the alternatives. So we kind of talk about a 70-30 risk profile, but we're leaving out the calculation of owning alternatives. And so as a reminder, those are essentially anything that isn't a stock or a bond. And in this case, we own primarily private equity, real estate. We'll talk about something new we want. We own some commodities, so like oil, coffee, that type of basket of commodities. And so those couple of things, they behave differently than the rest of the market, which is great. That helps with that, again, philosophy of we want to protect in down markets. But they also, since Parker is here, they also add a longer, generally speaking, he can correct me, but they add a higher, longer-term return. That's the calculation for alternatives, is higher than the rest of the portfolio. And so when Parker is calculating the discount rate, it benefits you to own some of those investments. So you've taken our advice, and so that's been great and has hopefully helped with that really high discount rate, which is awesome.
Yeah, for example, Parker, when he does his annual analysis, he'll ask multiple companies for their long-term rate of return. And correct me if I'm wrong, but on his calculations, on public equity, it's a 6 to 8% return calculation going forward currently, and on private equity, it is somewhere between 9.5% and 10.5% return.
Say the exact number on the most recent.
Oh, look at that. He's a math guy, of course. He's like an accountant.
Sort of.
Sort of. Math people, they need to give the exact. I'm married to a CPA, so it has to be exact number.
I know the numbers in the reports are supposed to work quick enough to need it.
But as he's looking for that, also on the, we have 10% of that portion in the private markets, according to the IPS or the investment policy statement. But that helps within your calculation as he's looking for the number, doing the math. So that's all part of it, and giving you diversification.
The alternatives right now are 8.85 for long-term expected rate of return.
Alternatives as a basket. Alternatives as a basket.
Yeah, the basket, yeah.
Okay, so that's including the real estate.
Yeah.
Okay.
Well, real estate's slightly higher than that actually, but they're a separate class. But-
So what is the basket return? 8.
Well, the 8.85 are alternatives, non-real estate alternatives. So if we go to real estate itself, real estate, is that it there? Let me see if we get that.
We haven't talked to Parker in person on this one for a bit, so he.
And real estate is at 8.75, so.
And then what about public equity?
Public equity large cap will get you at 7.41, small cap at 7.59, 7.79, developed markets at international at 7.82, and international emerging at 8.65.
Okay. And then private equity, or do you not have that?
Private equity gets folded into alternatives.
Okay. When I did talk to him in the past, it was like that 9.5%, 10.5% return just for that single. So, okay, good to know. So that's just a little bit of an update on that.
Yep.
Thank you, Parker.
So, just going into page 5 quickly before we get into some of the holdings. Page 5 shows you calendar year by calendar year returns. And so it's been kind of interesting because I keep saying to clients, and we keep saying to clients, that we don't expect double-digit returns every year. But if you look at 2019, 2020, 2021, and so on, they've all been double-digit returns, whether it's been, mostly up. 2022 was obviously double-digit down return in the market. And so we've just been in a very strange time where we've had COVID, we've had a Russia and Ukraine crisis, we've had interest rates rising at a astronomical pace. In 2023, we're talking about recession, and that ultimately doesn't happen. 2024, of course, it was an election year, and so October was a little bit rocky, and then November right away was really strong market. And so for us, it's just been a very strange market, but the benefit of Opeb is that it's so long-term. We don't try to make these tactical decisions. We didn't try to say, oh, we think so-and-so will win the election, let's place some trades that would, we could get some extra juice from it or something like that. We don't do that. It's not good from a political perspective, of course, but you're going to be wrong if you try to bet on things like that. So we're long-term focused. We've just had some really strong years. And so to that point, 2022, of course, the portfolio was down 15.8%. But if you look to the right, I know we've mentioned this before, but just for some context, the stock market was down 18%, bonds were down 13%, your alternatives were down 5%, so down less. And then in 2023, stocks were up 21%, bonds were up 6%, alternatives were up 6%, and now in 2024, the stock market was up, so far 19.5%, bonds up 3%, alternatives up 7%. So everything, where 2022 there was nowhere to hide, since then everywhere has been really strong. So we'll take some credit, but I always say, expecting double-digit up returns is just not what we expect in the long run, of course.
Kathleen, before we move on.
Yeah.
I don't know if this is a good spot to talk about it, and if you're not prepared to talk about it, that's fine too. But, what are you seeing with all these proposed tariffs coming up, and, any thoughts on what that's going to do to the market?
Yeah, so, well, it's hard to know. What I will say is, and it works perfectly actually if you go into page 6, what we're concerned about that goes with tariffs, but it goes with more than that, just geopolitically, is international in general, and certainly policies with the new administration favor domestic, right? But that's been something we've been thinking about for several years. So I hesitate to say that it's all because of a new administration. But for example, one of the things we've worked on in this portfolio in other towns is our exposure to China. That's something that we are not very comfortable with owning a lot of exposure to China. And so that's something we've adjusted. We've adjusted international equity overall, because kind of to your point, there's a lot of risk there, whether it's tariffs or, wars, or Taiwan being invaded, anything like that, we're cognizant of there being more risk there. However, that being said, I'm going to steal what Brian always says, is that, again, without trying to get political, 4 years is a short amount of time. And so policies in 4 years, yes, they can change for good. Typically, things change pretty quickly, and for Opeb, you're looking further than kind of a 4-year person's policies. That makes it sort of a cop-out answer, I'm not going to lie, but
It's not. It's absolutely the truth. I mean, we're looking at a long-term,
Yeah,
who's going to be the president in 20 years? I couldn't tell you.
right. Right.
But it's irrelevant to what we're doing.
Right.
When I look at my personal 401k,
Ah,
excuse me, it's slightly different, obviously, because OPEB's young in nature, right? OPEB is a young 5-year-old and not going to touch the money for another, 40, 50, 60 years. I'm 51 and going to maybe touch my money when I'm 70 to 80 years old. But even right now, regardless of presidential candidates, if you want to know my personal opinion, I'll tell you on the side after 5, but not now. You don't pay us for a political view. We do look at both sides and we analyze it, and we may make points on various presidential election results, but we're neutral in that regard. But the bottom line is I continue to stay the course of what the plan is for my funds and what I'm trying to achieve. So you just stay the course. You keep, whether you're dollar cost averaging once a year, which is still dollar cost averaging, you're in accumulation phase. So you keep adding money in every year. And just remember the long-term picture. Relatively speaking, I know not necessarily everybody in this room, 48 years is a short period of time, but it really is a short period of time for the grand scheme of things behind the backdrop of OPEB being so young in nature. Okay?
Yeah, and to that point, I'll just talk about some of the other just asset classes while we're here. So, as I said, international equity, we still own it. We're not, you have to remember too, international companies can be multinational in nature. So Visa, I use the example of Visa all the time. That's an international company, but they do a lot of business here and elsewhere, a lot of different countries. And so when we're looking at international, we're just a little more cognizant right now about what we're owning. You have your alternative exposure, that bottom section there. That's where, we were talking about all of the private equity, and those have done really well. Stepstone year-to-date is up about 12%. Same with, Clarion's up about 4%. So you have everything's positive in there so far year-to-date, which is good because in a really strong market, we think alternatives will lag a little bit. That's kind of what we expect, but they've actually done really well so far this year, which is great. And then finally, about just the domestic bonds, this is where we, unlike, an election with the Federal Reserve, it's really important that we pay attention to what the Fed is doing. It matters what's going on here. It matters what goes on the rest of the world. And so we probably mentioned this a year ago, but I'll mention it again. Interest rates went up so aggressively. And so it was really attractive, in our opinion, to buy treasuries, buy longer-term treasuries, because we decided we didn't have to be as creative in the bond portion. When interest rates are at 0, we're kind of desperate to find a place to go, and so you end up kind of looking at high-yield bonds, which are lower credit quality bonds, just to try to make your bond portfolio do something. But it's been a different environment where we've been able to buy a lot more treasuries, where they're paying, 4 or 5%, and you're in the safest investment in the world. And so we've done a lot of that. We still maintain a lot of that exposure, which has been great. And that's really it.
You want to talk about, let's just talk about the rebalancing on a couple of the positions of domestic equity. Did you talk about that?
Yeah, so.
And also the Blackstone.
Yeah, so we've made a couple of changes just very quickly. If you look at the domestic equity portion of this portfolio, the fourth one down, you can see we purchased a new mid-cap growth fund as of 11/20/2024. Prior, we owned BlackRock, a BlackRock fund, which, has some headline risk, but that wasn't really why we sold it. It wasn't any really reason for that. It was just a very volatile fund. They weren't really doing how we expected, and the investment team was talking to them constantly and didn't really like some of the answers. And so because we're an independent firm, we don't have to hold on to these investment funds. We can, if we don't appreciate what they're doing, we can sell them and move on. And so this was a situation where the investment team was ready to sell that fund for a while, wanted to find a really good replacement, and did that. We try not to do that so often. We want to have conviction in our portfolio managers, but if something happens and we don't like where things are going, we'll change. And so that's an example of that. And then on the alternative side, we owned a real estate fund. So the mid cap was BlackRock. Your alternative fund was Blackstone. I'm always just want to make it clear. Different companies. Both have had some headline issues. But you're a B REIT on the real estate side. We moved on from that fund. Some of it was to do with some of their governance issues. Another was to do with the fund was just huge. It was way too big. And when you're a real estate fund and you want to buy a good piece of property, if you have billions of dollars in your fund, buying a piece of property isn't going to move the needle. You have to, at that point, buy tons, a huge property or make these kind of bigger trades that we just weren't comfortable with. We wanted a smaller, more nimbler fund. So I know I'm kind of going into the weeds, but that was something where, a different situation where B REIT had done really well. And so you did really well being in that fund, but we wanted to move on before things changed, let's say. So we added a different one, Clarion.
And they've been talking about closing that fund for years, but they just got bigger and bigger and bigger and never closed the fund out. So all these things in the back of our heads are, time to move on. It's in comparison, as Kathleen said, like buying one investment property in Sutton versus buying the whole town. That's a really good analogy. In order to move the needle to make a big impact on the investment, you'd have to buy the whole town. So it just became more challenging and time to move on from that fund, as we felt. All these are within the confines of the investment policy statement, otherwise known as the IPS. We're following that guideline as stated and executed by the committee. No changes on that. We're following all within the confines. The rebalance on that alternative sleeve happened through paperwork back in August, but none of the changes have been made in terms of the investment policy statement. The one last add-on that we would recommend that does not change inside the investment policy statement, except for the addendum, it tweaks it just a bit. When I say just a bit, it's private credit. That's the latest add-on that we would recommend. It represents 3% of the portfolio is what we would recommend. It's with one of the companies that's time-tested, AMG Pantheon. It's been a while since we found a good company that we vetted through. We found that we not only have a history with them, we like that private credit market. The one tweak in the addendum for the IPS is instead of in liquid assets on the alternatives, it's going to say other alternatives because 3% of it is now not daily liquid. It's monthly or quarterly. So we had to alter that. We haven't done it yet, but that would be the alteration for an update. I don't believe that constitute is a change, but I'll let you decide that on just the addendum for an update on the signed IPS or the investment policy statement.
Okay. You said 3% into...
Private credit, and I can explain that if you want.
Right, but is that, so you're going to be moving some money, are you going to be asking us to vote on moving some money from one of the other funds to add more to the alternatives?
No, we don't necessarily need you to do that at all. No, let me make it clear. The change in the addendum on the addendum for the targets, we had to have clarity for full transparency. Right now, it has liquid assets at 10%, private equity at 7%, real estate at 3%. And on what we would change is that sample language on the top one. Instead of saying liquid alternatives, it would say other alternatives, because it needs to be more clear in the definition, because 3% of that 10% would not be daily liquid. We just don't. It's semantics, quite frankly, but we're all about full transparency and accuracy. Does that make sense or answer your question?
Yes. So to make that minor change in the IPS, will that require a committee vote, or is that something that the treasurer can just sign off on?
I believe the custodian, AKA treasurer, custodian can sign off on that, because there's no change in the investment policy statement body. But I'll defer to what you want to do.
Any thoughts?
So you're not saying you're changing the investment, you're just recognizing that there's some definitional changes in the policy statement, is that what you're saying?
That's what I'm saying.
So the money's not immediately liquid, but within a quarter or a month, or, you know, there's various timeframes. I don't see an issue with that. I mean, right now, we're putting money in for the next, you know, however many years, and I don't think the daily liquidity of any of this money is terribly important, but
I would hope not.
And just clarity through the chair, if I may, that only represents 13% of the portfolio that would be monthly or quarterly liquid. The rest of the portfolio is daily liquid securities.
Chris, do you have any thoughts?
Only to point out that I don't think we should think about liquidity just in terms of needs to withdraw from the fund. That's also going to be, if we want to make changes in allocations, right, the liquidity is going to be curtailed on that percentage. It's not a big percentage, and I'm not advocating against. I just want to make it clear that when we talk about liquidity, we shouldn't think about that just in terms of withdrawing funds, you know, in 2045 or beyond. But in terms of our ability to change allocations within, you know, can be impaired by what's not daily liquid. And you know, again, I don't think the 3% is a material number in that regard.
Okay. You can continue.
Okay, excellent. I wasn't sure. Thank you. If it may,
Just defer to your ability to make the change if you want to sign off on that. And it's the way I feel about it, so. I think we need to take a vote.
All right, sounds good.
so that's our only additional recommendation at this time, to add that 3% in private credit, along with moving the private markets from 10% to 13%, and making that definition change in the addendum in the IPS.
Okay.
Any questions, concerns, comments? Was that exciting enough? Okay. Well, thank you.
Done? Oh,
Do you have anything else?
No, that's-
Sure.
Any questions or comments from the committee?
So I think what I heard is 16% returns every year.
except 22, where it went down 16.
Right.
Yeah, the targeted return is 7, we're trying to target 6.5, 7% return year after year. Some years are going to be 14, some years are going to be negative, but the goal over time is 7%. Now, the town administrator said a good point, and I don't know if anybody caught that. Whether you're doing personal investment or town investment, it's timing. No, excuse me, it's not timing the market, it's time in the market. And I wish I knew that at, 16 years old. I would have fully maxed out my 401k as much as I could have, right? So, but it's time in the market, and you have a lot of time on your side. So thank you.
All right, thank you, Brian and Kathleen.
Yeah, thanks.
I have a follow-up for Parker, if I may. Sorry, Parker. I was looking at, you went through this presentation, projected cash flows.
Yeah.
And you say, I thought I heard you say that in 2045,
Ish, yeah.
we start withdrawing and using that to pay retiree benefits, is that correct?
Correct.
So, so that's sort of in my opinion, our new bogey is 2045, not 30, 40, 50 years down the line.
Yeah.
Because, we will need to keep this contributing to keep this going, but it's really just 20 more years, and then we can start using these funds to offset retiree health benefits, which will benefit the town budget and the future of this town. So, all right.
Yeah. The thing I would point out, this is what I tell a lot of folks, and the advantage of working with folks like Kathleen and Brian, is that right now you're 22% funded. Being aggressive makes a lot of sense. You have a long way to go to get there. But now let's say in 2038, you're at 88, you're 70% funded. Well, at that point in time, maybe you want to start taking some money off the table and be a little less aggressive, because now you've come a long way to climb up the mountain. You don't want to slide back down the mountain.
So close, yeah.
So as you get closer, you target your allocation, much like, to Brian's example, when you're getting closer to retirement he's going to see the money in 20 years, not 40 years. So you can adjust your allocation, and that's the advantage of working with folks like these guys. You can adjust it based on whatever your needs are to reflect whatever the situation is.
All right.
It's not a one-size-fits-all, I guess, is my point.
Yeah, and so, in not 45, but 48 in this chart.
Yep.
We're using 1.8 million? Is that correct, or?
It'd be 1.4 million coming out, 1.8 is the 2053 year.
Okay,
So yeah, as opposed to putting 700,000 in, you'd be taking 1.4 out.
okay. And one can just, if we stop doing this and didn't do it, then, the impact on the town budget would be enormous.
Yeah, well, the example I give is like right now, your pay-as-you-go costs are about $535 a year. Come 2043, it's 1.3 million. So I guess my point is, if you guys had to find another 600,000-700,000 in the budget each and every year, how easy would that be to find? Most towns I know, they don't have an extra 600,000 or 700,000 laying around looking for a good home. So that's why I encourage people, like I said, demographically, listen, I grew up in the Northeast, I'm a fan of the Northeast. This is not where people are moving to. This is not the growth area. This is not Phoenix or Miami or Dallas. And so geographically and demographically, you're going to have fewer taxpayers down the line. People are getting older around here. And unlike the U.S. government, where we tax you worldwide, if you want to move to Europe, I'm still going to tax you. If I leave Sutton and go to Miami, I got services from Sutton for 40 years. And then when the bill came due, I said, nope, I'm out of here. I'm going to Miami. And that taxpayer-supported debt I was talking about, Mass and Connecticut and New Jersey, 2, 3, and 4 on the list, very, very high. They're going to get stuck with the bill. Nebraska, surprisingly, has almost no state debt. It's a tiny little fraction. It's unbelievable it can be that small. But that's why they're 50th and not they're in the Northeast.
Well, I don't know that they offer retiree health care benefits either, do they?
They don't offer a lot of benefits.
Okay. That's good for me anyway, my edification.
So, some people in this room have long memories.
Yep.
So in 20 years, when we're asking about this,
Yep.
they'll recall what we said today. I think might have been in the other presentation that you gave to us, you had a list of the impact of previous changes in assumptions on our OPEB liability.
Yeah, last year would have been a bunch of assumption changes because it was a full valuation.
And if you go back 10 years, you had some years that went way up and
Yep.
some years that went way down. So what would your confidence level be in, a 20-year target for crossing over into fully funded?
Is it 100%? Absolutely not. Because again, I don't control what the feds are going to do on Medicare and things like that. So, but I think based on what you guys are doing now and what lifespans look like right now, which have actually gone in the other direction, unfortunately for retirees, right now I'd say you're better than 50-50. I would say plus or minus 5 years is probably a good number for that. But again, here's the thing. It's kind of like Kathleen showed. In 2019, 2020, 21, markets are sky high. Oh, 2022. 23, 24, great. Things are going to be volatile. OPEB is extremely volatile. We talked about 12%, renewals. But a couple of years ago, you're having flat renewals. It's a much more volatile thing than pensions are, because in pensions, it's all based on pay. And I know people are going to I'm going to target a 4.5% pay increase. They're going to get between, say, 3 and 6. In the case of OPEB, I'm going to target a 5% healthcare cost inflation between -5 and +15. I have a much wider spread. So that's really the problem with OPEB is you don't control when people go to the doctor or what they do when they get there. But yet you get stuck with the bill. And that's really the problem with OPEB. And so it's a matter of, in prescription drugs, I guess I could ask you the question is Medicare, the current administration said they're going to do this, but we'll see what happens. Is Medicare going to start covering GLP-1 drugs, the Ozempics, the Wegovys, and stuff like that? If they do, you could argue, bankruptcy is not far off because those things are ungodly expensive. On the other hand, you talk to people who take them, and they're a lifesaver. They do wonderful things. So I don't know what the right answer is, but those are the kind of things, what's going to be covered. And those are the things that, unfortunately, you guys don't have any control over. You just get stuck with the bill. Unfortunately, stuff does run downhill.
It's just interesting you mentioned pensions, because our pension liability with the state, you know, where they have a fully funded date that just itself keeps getting pushed out and pushed out. You know, it feels like you're never going to get caught up with that.
Yep, that is a definite problem, and, you know, people in our profession would tell you that the state has been overly optimistic for the better part of almost 40 years in terms of what they're gonna do. And again, going back to the earlier comment, it's politically to tell taxpayers, hey, the liability is really this much higher, and you guys gotta kick in more money. There's no votes in that. So you look at, you know, places like New Jersey, Illinois, Connecticut, Kentucky have massively underfunded pension plans because you have no legal requirement to contribute. And so when election time comes, you go, I can cut the contribution, I can cut taxes, I can get elected, and I'll kick the thing down the road. You know, again, it's easier said than done. People who don't, as I tell clients all the time, I don't have to get elected to anything. Very easy for me to say, do all these things. But people have to get elected, I get it, you know, it's not easy.
Okay, thank you.
Yeah.
Thank you.
All right. Anybody else have anything? Any questions? Nothing? Item number 6, old business, new business. Anybody have anything for that category? All right, seeing nothing, then I guess next step would be to take a motion to adjourn.
So moved.
Second.
All right, we need a roll call vote.
Lisa Lynch, aye.
Harrison McKinley, aye.
Tim Harrison, yes?
David Hall, yes.
Chris Woodruff, yes.
All right, thank you, everybody.
See you, Chris.
Thanks.
Thanks, Chris.
Recording stopped.